As we approach the end of 2023, now is prime time to start doing Roth conversions. In fact, all of our clients just came in over the past few weeks, and about 90% of them opted to do Roth conversions this year. So they voluntarily paid more in taxes to the IRS this year for the future benefit of having tax-free growth in those accounts. Now, if you're trying to do Roth conversions on your own, you want to use extreme caution here because these things are irrevocable. You mess this up, there's nothing anyone can do about it to go back and fix it. And it could cause some other harm to you the next year. So in this video, I'm going to give you 7 different Roth conversion mistakes that you should avoid. So mistake number 1 is timing. So Roth conversions don't make sense for everybody every single year. There are some years my clients do conversions, and there's some years we tell them to skip because things change. They had other income, they sold their property, something happened. So Roth conversions are generally a good idea. It's not right for everybody, and it's not right every single year. So you want to take timing into account. Is this a high income year for me? Is it a little bit lower? Is there room to convert here? So remember, take timing into account and don't assume that in retirement, I'll be making less, therefore be a less tax bracket, because a lot of times that isn't the case. You might make less money, but it doesn't necessarily mean you're going to drop a whole bracket. And there's nothing guaranteeing that the bracket's going to stay the same. It could very well go up in the future. So you could drop a bracket, then the IRS changes it, and now taxes are higher than they were to begin with. So don't put it off just because you assume taxes are going to be lower. Second mistake is forgetting about the RMD. So RMD is your required minimum distribution amount. So that doesn't start until age 73. So if you are in your 70s and wanting to do a Roth conversion, your RMD amount has to come out before your conversion. Your conversion doesn't satisfy that need. So when these RMDs hit, the IRS says, hey, you need to take a minimum amount out of your account. So if the RMD is 10,000, and so you're not even touching your Plan 3 account or IRAs or anything like that, and they said, the IRS says, hey, we need $10,000 to come out in the form of an RMD this year, you have to take that money out before you do your Roth conversion. If you said, hey, I'm just going to do a Roth conversion for 10,000, and it's the same thing, right? It comes out of the account, it does not count. It doesn't satisfy the RMD rule. You get hit with a penalty of 25% for not satisfying that. So you want to make sure you satisfy the RMDs before doing the Roth conversions once you're over age 73. Third mistake people make with Roth conversions is forgetting about the 5-year rule. So Roth IRAs have 2 5-year rules. The first one is about contributions. The second one has to do with conversions. So the conversion 5-year rule is once you convert the money, it has to sit there for 5 years in order for the interest earned to be considered tax-free. The money you physically put in the conversion, that's yours free and clear. You pay the taxes when you did the conversion, but the growth has to sit there for 5 years before it's able to be considered tax-free. Now, every conversion has their own 5-year period. So you have to kind of keep tabs on that of how much of it is actually tax-free versus how much hasn't met that 5-year rule yet, and I have to pay interest on it. So if you forget about this and you say you had $1,000 of growth, you took all that growth out the first year after you converted, that $1,000 now counts as taxable income. And it's going to impact not only your taxes, it also is going to affect your Social Security, potentially your Medicare, depending on where you're at. So that's one mistake you want to avoid, is taking that money out too soon after doing the conversion. Mistake number 4 is going all in. So we've seen some people get a little too carried away with this, and they see the numbers like, hey, if I just paid all now, I paid the least amount of taxes. And that's not always the case. You usually use simple numbers like maybe 20%, 25% to get the point across. But keep in mind that your taxes have different brackets. And if we convert too much, we might jump 1 or 2 brackets, and you might be paying something like 32% instead of 22%. So just because it seems like a good idea on paper doesn't mean you want to pull the trigger and do it all at once, because you're going to bump up tax brackets. And it's usually better if we were to spread it out over a few years. You might pay a little bit more in taxes that way, depending on how it grows, but it's usually going to be better than paying a whole 10% more in the first year just because you were just too excited about the opportunity here. Next mistake has to do with the opposite, and that's doing too little. Some people, I don't think, quite get the concept of Roth conversion. They do little amounts. So I have some people that they have $400,000 in IRA, and they want to do $5,000 of conversions or $10,000 of conversions. And that's a good move, but it's not doing enough. I mean, a $400,000 account, you take $10,000 out, it's still going to grow and make back that $10,000. So the account never depletes, and it's going to still be growing. So you need to make sure you're converting enough to make a dent, because the whole point of the conversion is to ideally reduce our balance of our taxable accounts So we have less RMDs in the future. There's less money growing, which means less taxes that are also accumulating in the account. So if we don't convert enough, it's still a step in the right direction, but ultimately it's not as tax efficient as it could be. So make sure you're converting enough. If you don't know what enough is, talk with a CPA or an advisor. So the next mistake we're talking about is something called IRMA. And all it has to do is how much that Medicare charges you in premiums. So if you make too much money, you're going to pay a higher Medicare premium than people that make less money. And there's different thresholds. The reason I'm bringing this part up is it's what's considered a cliff number. So if you go over that limit by just $1, you are automatically locked into that higher price for the next 12 months for both you and your spouse. So it's something you really want to watch for. It's not like our tax code where if you dip into the 24% bracket, only that dollar that goes over is taxed 24%, not all of it. This is not the case. You go over it by just a little bit and you're permanently on that higher tier for the next 12 months. And the next tier, just so you get an idea of it, is typically about $66 more per month than the base Medicare premium. So instead of paying something like $170, you're paying $230 a month per person for 12 months. So it's something that a lot of people don't realize is there when they do conversions on their own. If you don't have the right tools and knowledge in place and you just start pulling triggers to convert money, you might accidentally trip one of these barriers, and now you're paying higher Medicare premiums, which hurts and is in a way almost, it could be less efficient. So it's not necessarily something you want to avoid, it's more to be aware of. If it still makes sense in the long run to go over this limit, because you're going to save more in taxes by doing the conversion than not do it, then go ahead. So don't think of it as a barrier. It's just an obstacle we need to see if it's something we should avoid or if it's okay to go over for a year. Now, last mistake, if it hasn't been obvious yet, is not working with a professional. As you can see, I've covered a couple of different mistakes that you probably haven't heard about before. And that's because we do this all the time. So we've seen all types of mistakes. So you need to make sure you're working with an advisor that actually does tax planning. Not all advisors do tax planning. If they don't collect your tax returns, go through checklists, talk to your CPAs, they're probably not in the tax planning mode. So they're not going to be able to help you to the fullest when doing these type of calculations. So make sure you work with an advisor or a CPA that knows this pretty well and can give you the guidance you need to help avoid these costly mistakes. So Roth conversions are a huge thing that we do with our clients. And I know that's some area that a lot of state employees really need help with. Now, one thing I wanted to offer everybody was a free one-page financial plan. So this is something that I'm going to manually do for you guys. So there's a short Google form in the link in the comment below, the link in the description below. You can go ahead and fill that out. I'll take the information. I'm going to give you guys a one-page plan that essentially calculates how much your estimated pension is, if there's any penalties that apply, and I'm going to take taxes into account. So I'm going to give you the gross and the net benefit you're expected to, and then there'll be a few tax questions on there, and I'll make sure to address that in the plan as well as some personal liability or risk management questions that also will be addressed on there. Now, because this is such a manual process, I have to limit the amount of people that come in to just 10 to 15 per month. So if you click on that link and it says we're not accepting responses this time, make sure to save it and come back, or you can email me to get on our wait list, and I'll let you know when it opens back up again. So in order to make these high quality, I can't open it up to everybody. I have to limit it. So if this is something you're interested in, go ahead and fill out that link below. If it's not available, shoot me an email and I'll put you guys on the list and let you know first before I open it back up to the general public. So that's it for me today. Remember that your future depends on what you do today.